Good morning, everybody. Thank you so much for being here. I know it's quite early on a Sunday morning after a Saturday. I'm impressed that you're all here, even though it's possibly because the room next door is booked full. But thank you for coming so much, and I promise you I will not let you down. We're here today to talk about the future of VC. I'm Alex Mittal. I'm the CEO and co-founder of FundersClub, and I'm looking forward to talking you through this. Now, I don't know who made that graphic. I can't explain the graphic of the broken world, but I will do my best to explain my thoughts on venture capital. So these companies you should recognize. These are some of the most iconic companies of our generation. And all of them were brought to light, were brought to existence as fast as they were with the power of venture capital, with investment. And I'm here because I think VC is ultimately a positive force for the world. I think it moves the world forward faster than it otherwise would move. And the interesting thing about VC, though, is it hasn't always been around. It's actually a really, really new concept when you look across the history of humanity. Going back to the history of banking and money to 2000 BC, the Assyrians would give out grain loans to merchants and farmers traveling between cities. You would have later on the Greeks and the Romans from their temples lending and changing currency, and similar things happening across Asia. And this was millennia ago, right? So the banking system, loans and so forth have had millennia to evolve. And contrast that with VC, where the people who created the industry, although slightly older, slightly grayer, some of them perhaps talking about the trials and tribulations of the 1%, Tom Perkins there, but overall, very much still alive. It's a really new industry. In fact, it was only in the 50s that Arthur Rock there on the upper left-hand corner left his banking job and decided to back the guys who founded Fairchild, which spun out Intel as well. And up on the upper right, Don Valentine, the founder of Sequoia, which would go on to fund companies like Google and Apple, or folks like Pitch Johnson over there in the lower left-hand corner, who together with Bill Draper in 1962 leased two Pontiacs, drove around door to door looking at companies that sounded like they were technology companies, knocked and asked them, hey, do you want some money? So this is an industry that started just in the 50s, 60s, within some of our lifetimes here. And honestly, it hasn't really changed that much. So it's been an industry that hasn't had to reinvent itself. It's followed the same path for a long time. But something is dramatically different as of, let's say, the last 10 years. And I promise you, I don't want to overload you with numbers, so please ignore all of the numbers up here, except for what I'm about to say, which is, this is a chart showing venture capital returns relative to the public market, various public market benchmarks like the S&P 500, the Russell 2000, which is an index of smaller companies. And basically what it's showing is, to the right of that vertical line, you'll notice that the top line, which is the venture capital index, vastly outperforms the public markets. And that's from the era of the folks that I just showed you, these fellows here. And that was great, but the problem is, and this is by the industry's own admission, so this is not new what I'm sharing with you, but in the last 10 years, it's been very hard for venture capital to beat other asset classes, to beat the public market. And why does this matter? Like, why do we care? Well, it turns out that VCs, in case you're not familiar with the industry, have their own investors. They have what are called limited partners who are choosing to deploy their capital in venture. And if they stop doing that, there'll be less capital available to startups to try new ideas, to bring innovations to the world, and to have those see the light of day. And in fact, a survey from last year of limited partners in VC funds concluded that most LPs plan to decrease their allocation to the venture capital asset category over the next few years. So this is actually a pretty big problem. Now, why is this? Well, there's a couple things. Starting with, it's actually really hard to be a good VC. So this is a graph showing on the x-axis exits, so exits over $100 million. And it's logarithmic, which means rather than going up incrementally, you'll notice it goes up by orders of magnitude. And on the y-axis is the dollar value of exits. And this includes, if it's a public company, it includes the valuation of the company today, which is why you see like nearly $1 trillion valuation up there. But if you follow this line all the way and extrapolate it, you'll see the vast, vast majority of companies actually don't really profitably exit. And so it's very hard for VCs to make a return. So that's one explanation. But why would people even participate then if it was so hard? Well, you can see here, digging deeper into the data, this blue line here is showing the maximum returns. So the most returns that a VC fund has made in these different vintage classes of VC funds. And you'll see there are some years, like in 2005, there's a VC fund that returns 100% annually to its investors. So like $100,000 put in the bank at a 100% return rate would be worth $100 million a decade later, which is obviously phenomenal. But then there's phenomenally horrific results as well, leading to a median return for the industry that hovers around 0. And so there's a number of explanations. The industry has looked within itself and said, why is this happening? Like, why for so long has the median been so low? And some people, and I would say this is sort of the glass half empty or half empty camp, basically says that there's too much money in venture, that there just aren't enough backable companies that will go on to be successful. And actually what these folks say is what the industry needs is right-sizing or downsizing, and basically like, let's slash in half the amount of capital. It's great that the limited partners are pulling their capital out of VC, like that's awesome. VCs will have better terms. With startups, they'll be able to get better exits and so forth. But actually, I think there's another explanation, and that's what I'm here to talk about today, which is two things. One is information opacity or obscurity. It's basically very unclear. There's no clear picture of what is actually happening in venture capital, sort of like the results measuring. If you can't measure something, you can't really improve it. And I'll walk through a couple examples of that in a second. And the second thing that I think is evident is in this day and age, it's a different time from the 40s and 50s when you would drive a car up and down a street to find startups to invest in. It requires a new way, and there are new tools to surface innovations that simply don't fall into the structure of traditional venture capital. And so things are and do need to change. So here's an example of the first point, which is just nobody actually understands what's going on in VC as far as data is concerned, for real. So let me explain what you're seeing here. These are two different slides from somebody else. On the top is active US venture capital investors in the United States over different years. And what it's basically showing, if you look at the far right from 2010, 2011, 2012, is that there are more and more active VCs there. So the proposition of those people, and by the way, their day job is to study this industry, is that there are more and more VCs who are investing. Now, on the bottom slide, it's the exact same trend that they're analyzing, basically the number of active VCs in the United States who are investing. And you'll see on the far right from 2010, 2011, it's actually showing a decrease or at least flatline. And so, what is going on? It's not really clear. And this is just one example. I promise you, if you dive into the data, you'll see all sorts of interesting discrepancies. For example, and this is really notable, this slide is for PE funds, but the same holds true for VC funds. 77% of VC funds can claim to be, and rightfully so, without lying, in the top 25% of the industry. So imagine a race where the first place winner through the 77th place winner are all top 25. And the reason that is it's quite, first of all, there's not very clean data. Depending on what data source you use, you're ranked differently. And you can sort of pick your best starting point to measure your returns by. And so I hope that sort of gives you a picture of what we're dealing with. And now to the second point that I was talking about, just sort of the glass half empty idea of there not being enough investment-worthy opportunities. This slide shows basically that last year, 2/3 of companies that exited never raised any institutional capital whatsoever, so venture capital, private equity, growth equity. And I didn't have a graphic for this, but probably even more impressively than that, because one could say, well, maybe those were all really small companies, they didn't need venture capital, it wouldn't have made sense. The Kauffman Foundation, which is a notable LP, they've invested in over 120 VC funds, put out a report a few years ago, and they looked at the companies from the Inc. 500's fastest growing companies in America, so the fastest private growing companies in America. And from 1997 to 2007, what they found is of these hundreds and hundreds of companies, America's best, fastest growing companies, only 16% had taken venture capital. And so, it's kind of hard to say that those companies wouldn't have been attractive investment targets, all right? And so what it actually is saying is those companies succeeded in spite of not being backed by venture capital. And it sort of gives you a sense of what the potential might be to bring more innovation more quickly to the world. So change is definitely coming. And it's coming in, I think, 3 ways. So first of all, there are now democratized ways of fundraising, democratized ways of supporting new ideas. And this probably most prominently started with platforms like Kickstarter, where pre-sales essentially can be conducted across a large group of people. And sure, not all of us here in 2012 wanted to have a 3D printer in our living room, but $3 million worth of 3D printers were sold by one particular company on Kickstarter in 2012, just as a quick example. And there are now actually platforms like FundersClub, for example, AngelList, and others that allow for even equity fundraising online. And in a similar manner, by accessing the entire world's interests, you are able to tap into not just the mainstream trends of what's hot right now, but what insightful, localized people, either geographically or by industry, the insights that they have. And that's really important because there's this concept in VC, which the best VCs constantly latch onto this idea. It was originated by Clayton Christensen, the Harvard professor and author of The Innovator's Dilemma, which basically says all great disruptive ideas start off looking like toys. They start off looking like toys that can be ridiculed and that seem quite silly. And this is such a powerful concept that folks like Chris Dixon at Andreessen Horowitz, Fred Wilson at USV, and so forth, Bill Gurley at Benchmark have consistently quoted this. It's actually a very real thing. And the really new, novel thing that is truly different today, that did not exist 5 years ago even, is the ability to tap into a wide network, to coalesce, to gather together a critical mass that otherwise wouldn't have come together, that demonstrates demand for so-called toys, and obviously in quotes, because these are the future innovations, these are the future Apples, Googles, Facebooks of tomorrow. And what's really interesting to see too is a coexistence. We're not talking about the destruction of Sand Hill Road necessarily, and I'll illustrate what I mean by that. Here are a couple examples of companies that have recently taken advantage of this new phenomena. You have Pebble. And I know this story from both sides. I know Eric, the CEO, and Tim Draper, one of his seed investors, and I've spoken with them both. But both of them were at wit's end, basically. After an initial seed financing round of a couple $100,000, nobody else wanted to fund the company. And so literally an act of desperation, listed on Kickstarter and sold $10 million of these watches, as I'm sure you may already be familiar with. But subsequently, having to produce $10 million worth of Pebble watches, they needed to raise venture capital. So it is not necessarily one or the other. These things can coexist and support each other. So they raised $15 million from Charles River Ventures after that. But then you have different versions of this story. So for example, on the far right, that's a picture of a beverage called Soylent. Yeah. And nobody wanted to back this idea when it came out. The premise is basically, hey, let's replace food with powder that you mix with water. And wouldn't it be great if that happened? And most people were like, no, that would not be great. But $2 million worth were sold in 6 months online using sort of a crowdfunding phenomena. So there are lots and lots of people out there who do think that's a great idea. And lo and behold, even though nobody really wanted to back this idea in the beginning, boom, institutional investors rushed in after. And so you see that story kind of happening as well. Now, it doesn't always work that way. In other words, it doesn't always start with sort of crowdfunding of a product, pre-sales. For example, these fellows down here are the Coinbase founders. Coinbase is a Bitcoin wallet. Bitcoin's a digital currency. And basically, they had, in the very early days, a hell of a time raising capital. Nobody thought this made sense. And they were able to use an online platform, FundersClub, my company, to finance themselves at the time when the Bitcoin economy was $150 million. And that was definitely a time when people thought it was a toy. But it was a $150 million Bitcoin economy toy. And the interesting note here, just going off of the past point, is they went on to raise from traditional institutional capital after. So for example, Series A, by then the Bitcoin economy was worth $1 billion, still ridiculed, still a toy. And then Andreessen Horowitz at the end of last year, $20 million from Andreessen, Bitcoin economy, $7 billion, quite an expensive toy. It'll be interesting to see when it stops being a toy. But that's sort of some quick examples of what's happening right now. The other notable trend that's changing is data transparency. So I had mentioned that historically the industry has been quite closed off and very opaque as to what is actually happening. Now, there's a reason for that. So if you're a VC, you have absolutely no incentive to be open about what you're doing, historically at least. So for example, if I want to buy a chair from you for 10 bucks, or rather for 5 bucks, but I think it's worth 10, I'm not going to tell you it's worth 10 because I want to buy it from you for 5. So you don't want to share your insightful knowledge about the future with anybody. That's sort of the inbuilt incentive. And as well as around results. If your results are amazing, if you're just generating high returns for your investors, if you share that with people, people will replicate your strategy and you'll be forced to compete more. And then conversely, if your returns are bad, well, it's obvious you don't really want anybody to know that. And it used to be that was fine. This is how it worked. But what's happening, and this is happening from outside the industry itself. In other words, it's not like people are starting to report the results and become transparent inherently, although that is sort of following this outside trend. But the outside trend is third parties are using new technology capabilities and data to start to put the pieces together, to start to try to put a more clear picture of what's happening. And I should emphasize it's super early. But for the first time, literally the first time in 30, 40, 50 years, you're starting to see VCs put under the microscope much like their own companies are when they're being evaluated. So they're being sorted, ranked, rated. The interconnections between their portfolios are being analyzed. The discipline of the fund managers are being analyzed, all with data. And this is really new. And I made the comment earlier that you can't improve what's not being measured. And this is definitely a step in the right direction. Now, the third thing is basically that there is, because of the move to transparency, which leads to accountability, because of the existence of more fundraising options at an earlier stage for founders, as well as the decreased cost of starting a company. It used to take like $5 million to start a tech company, and today you can start with almost no money. It's become a much more competitive business, and what that has led to is more public educational materials for founders. VCs trying to differentiate themselves there. You've got First Round Review from First Round Capital, The Grove from Sequoia. There's a whole list of different VCs who are trying to do this, all for the sake of competition, but in the end, obviously benefiting founders. And then on the other side, you've got, when they're supporting companies, obviously the most obvious example of this is Andreessen with a staff of 60 people helping companies with operators, with actual staff people, which is just unheard of from previous times. So the good news in all of this is that the entrepreneur wins. So if you're an entrepreneur, good news. All of these changes favor you. If you're a VC, actually, it's also good news if you're a good VC. If you're a bad VC, then it's probably bad news that the industry is becoming more transparent and more open. But in the end, I think everybody wins because this is all about surfacing innovations earlier, supporting them, and helping the world move forward faster. So that's all that I have today to talk about. I wanted to try a quick crowd investing thing here, though. I was given a Bitcoin to give away. Bitcoin's worth like $700 right now. If you're willing to invest your time to share with me what one passion of yours after, I will give you $20 worth of Bitcoin. So that's all that I have today, and thank you very much.